if you have great operations, you can buy an average deal and run it super well and make a lot of money. I think if you have bad operations, you could buy a great deal and you could lose money.
Welcome to Deal Flow with me, Michael Pulio, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week, I talk with industry insiders on everything real estate, capital, and prop tech. Today, we're thrilled to have Cody Littlewood join us. Cody is a trailblazer who transitioned from a tech-savvy entrepreneur to a key player in the real estate industry, focusing on Class B multifamily properties. Cody, thank you for joining us today.
Great. Thanks for having me, man.
Yeah, so I gave you a little bit of an intro there, but I'd love to hear it directly from you. And just a spoiler alert, Cody and I are business partners in Carbon. So we speak many, many times a day. And so this will be a little bit of a different format than our typical episode. It'll still be a Q&A, but a little less formal. And we'll just kind of talk a little bit about the woes of investing in real estate in the United States today. So Cody, with that, if you could just give us, in your own words, your bio, and then we'll kind of just chat about some stuff.
Sure. Yeah. I mean, long story, I'll try to keep fairly short, but I just grew up writing code on these old computers that my uncle sold to universities. I went to school and then became a software engineer through kind of a weird route. And I built a software services firm. I was building software for corporations largely in the commercial real estate space. So like JLL was a large customer of ours. And so I had a decent amount of exposure to real estate, but I had a lot of income, but it was incredibly tax disadvantaged. So my accountant kept telling me, oh, you should look at real estate. You should start investing in real estate, et cetera. And also start to diversify some of your income because all my income was tied up in, I didn't own any stocks. I didn't have any outside investments. I just had a company and I was making a bunch of money. But like if that went away tomorrow, it would have just been gone and would have been zeroed. So yeah, so I started buying real estate. I got really kind of passionate about it. Long story long. But to try to cut through the rest of it, I essentially just woke up one day and I said, building software for these faceless corporations isn't that fulfilling. And I really felt very fulfilled taking a shitty place to live and making it a nice place to live. There was a little bit of creativity in it. And it also was like much more fulfilling. And I felt like I had a more direct impact on people's lives. And I felt more fulfilled and I just felt more drawn to it. I like being in the field. I don't like being behind a computer all day, although we are behind computers a lot now. So anyway, so I put a CEO in place and then I started buying more and more deals myself. I was deploying a decent amount of capital, but I got to the point where I kept wanting to do bigger and bigger deals. I got to a deal that I couldn't do with just my own capital. And Michael and I knew each other through a professional organization. He was doing much bigger deals, but in the Midwest, he wanted to be in the Southeast and wanted to build a firm that was a proper firm that would be kind of a legacy firm rather than what he was doing before. And I wanted to do bigger deals and he had a bunch of experience and I'd done Fannie Mae loans, for example. This is my first Fannie Mae loan. I'd done only community banks up till then. And so we partnered on one that went well and then we had similar visions. So we kept going. So, I don't know, 4 or 5 years later and we built, have 1,000 doors at Carbon itself. I know Michael has some other stuff outside, but yeah, and then I think we built an incredible firm. I mean, we just vertically integrated, which Michael probably knows all about. And that's really been like both the worst and best thing that we've ever done. So I keep saying I'll never invest with a sponsor that isn't vertically integrated ever again after seeing the inside of how the sausage is made at a third-party firm. So anyways, yeah, so here we are.
Awesome. Well, that's great. Thank you for putting that together. It's interesting. I think a lot of people come at the real estate business from that high income, looking to save money on taxes. How can I do it? Not everyone decides to make a full career out of it. I guess a lot of people just write checks or something like that. I guess, could you speak a little bit about what led you to really want to become a principal, right? Like make this a career versus just, like you said, a stock portfolio. I just have some real estate in my portfolio. Why not go that route? Why go the entrepreneur route?
I mean, I don't know how to do anything else, I guess, other than go all out. And so, I mean, the more philosophical question is like, I don't know how to just do things part way. Or I guess the more philosophical or anthropological answer to that is that. But then I think the other side of it is obviously that, like I said, I became really passionate about it and I really enjoy real estate. I really believe in real estate. I like being in an industry that is part of Maslow's hierarchy of needs. I think I became very convinced talking with you about what you've seen with your family or people you grew up with, et cetera, and owning great real estate and great dirt over a long period of time and what that can do for a family. So I think it was a lot of things combined, but I'm also like, I'm not looking to retire. I'm 36. I got a lot of energy. No, I got a lot of stuff to build, a lot of stuff to do. And I don't know, I guess I could have invested passively, but that would have been a very boring existence for me.
If you're enjoying the insights and expert discussions on deal flow with myself, Michael Pulio, hit that follow button on Apple, Spotify, or wherever you listen to podcasts. By subscribing, you'll stay up to date on the latest in private equity, commercial real estate, and structured finance, and you'll never miss an episode. Plus, if you find our content valuable, we'd love to hear your feedback. Please leave us a review so we can continue bringing you insider conversations with market experts. Thanks for tuning in. So, I think getting away from the philosophical for a second, maybe speak a little bit about what's going on these days in the market. I have the benefit of being partners with Cody and having the benefit of his expertise and his willingness to be all in and to really go for and understand the ground game at a level that we kind of yin and yang in that way. And then I'm not that great in getting on the ground and really understanding the ins and outs of things. And, in my head, things seem simpler than they are in reality sometimes. And so I'm hoping you could speak a little bit about some of the challenges that we've gone through, that you've gone through, the team has gone through around this vertical integration. It sounds like that is a key aspect, certainly, of what you've been spending your time on. But also, I think it's a key to, for folks that are listening who are thinking of being passive investors or thinking of being sponsors, it's a big decision to decide, am I going to be vertically integrated or not? So maybe start with what that means and then kind of some of the challenges that it affords.
Yeah. So a lot of people will utilize a third-party property manager. And so there are many firms out there. They usually generally how it's structured for large multifamily properties is the property pays direct payroll and payroll-like expenses and any bill backs. And then the property management fee takes a 3% or 3.5%, sometimes 4% of gross collected revenue. And that kind of supports their centralized operations. So like your regional managers, your vice presidents, your HR departments, et cetera. And it's really hard to start out vertically integrated unless either you are very scrappy and you do it in a really piecemeal way and you are a very, spread thin principal, or you just have a lot of capital to be able to bankroll until you get to the point where you're large enough. I think that Michael and I probably had 3 of those things, right? We had a portfolio built up a bit. We had a decent amount of capital to be able to lay out to build the kind of vertical integration. And then we also, I think we're fairly scrappy, but it's really hard. Property management is, I think Michael always would say before we did it, that it's the worst part of the business. And many other sponsors will say that too. And it absolutely is the worst part of the business. But it's the difference between squeaking out break even or cash flow for your investors. It's the difference between at a 5 or a 6 cap, being 90% or 95% occupied could be $3, $4, $5 million of equity as far as value that you're creating. It could be hundreds of thousands of dollars of cash flow for your investors. And for a property management firm, like we were talking about earlier, they're squeezing out 3% of that total gross. That 3% is probably worth a couple $100 a month to them. And any property manager that you're going to hire at scale to manage a 200 unit apartment building, no one's going to care about $200. So your incentives are like totally not aligned. Their incentives are to get the bulk of their fee with the least amount of headache and the least amount of people dedicated to your property, because their profit center is coming from that 3% and their main cost is people. And so all their people are spread super thin versus us. Our main risk on the there is to generate returns and to generate returns, to increase the equity for our investors, to increase cash flow, to perform for our investors. Our customers are investors. And so we have very different incentives, and we don't care about making profit from our property management. We don't make a profit. In fact, we lose money, but we make money by creating better returns. And so I think there's just a general principal agent problem that constantly you're going to be facing with an external manager. Property management, for whatever reason, seems to attract people. Start as leasing agents and then they get promoted to a community manager, and then they get promoted to a regional manager, and they get promoted to vice president. And so people at the very top oftentimes are not the same types of people that are at the top in our side, on the private equity side, right? the levels of accountability are very low. I don't think much about building culture. They suck up a lot of their profit margin in people, right? And for us, we're like, we don't really care. We'll spend money on the people. We'll spend money on the technology. We have high accountability systems. We hire from outside the industry. We really focus on that execution side of things. I think we pull from other industries.
Could you spend some time a little bit on maybe bringing it down to the specifics of on the site about how do we hold, because you spoke to like, while there's some issues with accountability, like on the site level, how do we bring that level of accountability and maybe that friction where you were third party, it's somewhat difficult, but when you're first party and you own the company, you have an ability to create that accountability structure. Can you maybe talk a little bit about what type of accountability we've been able to put in place and how that's changed things?
Yeah, so several things. I mean, probably countless things, but one of the biggest ones though is something I mentioned earlier. Our people are not spread thin. Our regional manager has 6 properties max. A regional manager at a property management firm has double that. So just the ability to monitor at that level. Half the time, what we were finding is that people on site with a third-party manager were blocked because of the bureaucracy in their system. Our community managers, if they really got to get something out of the way, they can call me and I'll, whatever, give it. Like I literally have gone to Home Depot with somebody because they're like, oh, there's some issue here and I don't have a company card. And with the previous property management company, they would have been sitting there for a week without a part for an apartment. Whereas I'm like, here, take the card and go, right? So there's accountability both ways. I think we are much more accountable to our investors than I think, property management is a very sticky business. And so once you have a customer, it's really hard for them to switch, which I think that lack of accountability, because they're kind of like, are they really going anywhere? That bleeds down through the entire ranks. I just think in general, finance, private equity, like operational companies, I think we have a much higher level of accountability. We demand a lot more from people. We expect a lot more from people. I think that in property management, I've seen traditionally in the industry, like a fair amount of excuses. We run operational models like 40X, where there's really no excuses, right? We know the activities that lead to the lag measures that we know lead to hitting our major WIGs. And so we know if you're doing these things, that will lead to results. And if you're not doing those things, you've got a very short window to either start doing those things or you're out. And I think we've done a better job. We just set up a bunch of what we were talking about today because we're willing to make these investments. We just rolled out a Power BI dashboard that integrates with our Yardi instance and immediately shows live feedback against like, here's my goal, here's where I'm at against my goal. And even just very basic, like for anybody that's ran and operated a company or like worked in anything that has like very tangible goals, that probably seems like obvious, but it really isn't in the property management industry. Having an objective and tracking clearly along different milestones towards hitting that objective and looking at your lead measures, your inputs that lead to your eventual results. Very obvious stuff for, I think, most businesses, but just property management, real estate in general is a very old school business.
Yeah. No, I'm going to ask you one more question about site performance, then we'll get a little bit farther away from the space and talk a little about the economy and stuff like that. You spoke about the lead and the lag measures and the 40X system and kind of how we create that level of accountability, et cetera. Maybe could you speak to what are those key drivers of performance? What do you feel or what drives performance at the site level? If you had to bring it down to just 3 things or maybe maximum 5 things that if we get these things right, our sites will perform and then we'll be able to perform for the investors and the tenants.
Yeah, I think you and I were talking about this earlier. And then I was talking about this the other day, actually, with some other operators, some big real estate or some big portfolios up in New York. And they had like very similar perspectives, which was interesting because totally different markets, but same general perspective. I mean, it all comes down to occupancy. Occupancy is huge. We talk all the time about increasing rents. Well, 1% of occupancy on a 200 unit apartment complex is 2 units, and that's $2,500. And how much rent does just that 1% equal? How much rent would you have to increase just to hit that 1%, right?
$10 to $20 a month per unit, in case anyone was wanting to know the...
Yeah. So, but the difference becomes even more when you're looking at like 93%, which is not a bad occupancy number, versus 96%, right? Those 3 points.
Now you're $50, $75 a unit. That might be hard. That might be 5%.
Yeah. And it's way easier. And there you're talking about, I don't even know, you're talking about 6 units. That could be $8,000 that you could be sending out to your investors.
Right. Because most of that's going to be, that's the marginal revenue, or you're almost 80% of that's going to the bottom line, I guess is what I'm trying to get. Right. So you're the last 3, 4, 5 points of occupancy are all gravy, right? They're all going to the bottom line. They're all going to the investor, as you had said before.
Yeah. Yep.
So occupancy, what else you got there?
I mean, occupancy, collections is huge. Collections is like another area that you have to be able to sell. You have to collect on your revenue. I mean, it's like any other business, right? You have marketing, you have sales, you have accounts receivables. And then I think the other big one that people don't talk a lot about is maintenance. Maintenance is the number one driver of renewals and of happy or upset tenants, your reviews. And it's all this cycle. Me and Michael have these like philosophical debates all the time where they're what really matters, but everything is like this interconnected machine where if you have good maintenance, then you have good reviews, and good reviews are not just like feel good metrics. It means more people are going to lease your place because they're going to see a 4.3 star versus a 2.5 star down the road with operators that are trying to charge exactly the same rents. And that's a huge discrepancy. But really, I think like the number one thing, if you can do anything, is it's like every other business, right? And something I like need to drill into my head better is that if you can market and you can sell, you can solve that's like solves 99% of your problems. Because the better marketing and sales for us, that's leasing, right? It's finding prospects, touring, leasing, but it's just marketing and sales in any other business. It's just like marketing and sales in any other business. But the better your sales are, the more you're saying no to bad customers, which then leads to your delinquency and your turnover and everything else and your crime and everything else at your property, right? The stronger your leasing and sales are, the higher rents you can charge. The better your leasing and sales are, the better renewals you can get because you're not desperate to keep people in because you can't fill the back door. So I'm honestly like, if you could solve only one thing and like have everything else mostly work out, it's probably your leasing. It's probably your sales, marketing and sales. Get leads through the door, sign their lease. And the stronger that team is, the less everything else kind of matters.
And that kind of goes to it too, like the team, right? I mean, like making sure you've got bodies in the seats. As crazy as it might sound, like it is tough out there. We are competing against tradesmen, a plumber who can make $100,000 a year, who can't make that money at our property. So we're competing with other verticals, other business types for the best talent. And especially through COVID, maybe you can speak a little bit about talent and the important role that talent plays to the site.
Yeah, I mean, talent as well, right? We are right now, sometimes we are feeling like as we've been transitioning our properties over to our in-house, we've been feeling like we've been overpaying. But then we've seen the results on the properties where we have been quote unquote overpaying, particularly on our like incentive structures, not so much on base, but like really on those incentive structures. And the math just totally makes sense because the difference between a 93% occupied property and a 96% occupied property, it's only 3 points in occupancy, but a good person could be a difference. A good community manager or a good leasing agent could be a difference between 97 and a 90. So that's an even bigger spread, but even just a 3-point spread, let's say good people want to make a 3-point spread on your occupancy. But still, if you have a great incentive system, maybe that costs you $1,000, $1,500 more a month, but you're making $7,500 a month on that ROI. That's been like the number one, I guess, wake up call as we have. I mean, we've seen it before. We kind of knew it. Like we knew if we had great people on our site, most everything else would kind of take care of itself. Like the leasing and sales would take care of itself, which begets everything else. But I mean, we've seen a huge difference in having like proactive people who own their metrics and own their problems and come to you with solutions and are excited about the success of the property, can see the broader vision of the company and want to contribute to it. And the attitude of those people as I've been on site versus when we had a third party manager where it's like, stupid owners here just to like bug me and be on my back versus like the people that are like passionate about it and coming to me and are like, hey, we have this problem. We have this idea of how to solve it. It's like a night and day difference. And you see a night and day difference in the relationship with the tenants and the place that we're able to provide the tenants to live. So talent's huge. And in fact, property management and actually real estate could be argued, at least on the operational side. And I do think operations matters. I'm obviously biased. I'm talking my book, but I think operations matters more than anything. I think if you have great operations, you can buy an average deal and run it super well and make a lot of money. I think if you have bad operations, you could buy a great deal and you could lose money. So your acquisitions could be killer. You could have this amazing buy, but you could totally flop. And I think we've seen that on deals that we've examined or looked at in the past. And certainly when we had third-party management, we saw deals that we knew we bought well, but were underperforming where we thought they should be. And we've seen that turnaround as we've taken over. So I think operations is just like key. And then the key to operations is it's a people problem. And it sucks because it's like, especially for a CFA or, any finance person, right? You don't want that, right? You want all in a model, and it's like all this messy people problem. But if you can figure it out, it makes a huge impact.
Yeah. And I think we've been able to figure out a way to create a system through our recruitment pipelines, our assessments, again, paying people really well, incentivizing them properly around the things that we want, around those OKRs and then the 40Xs. So to get the outcomes we want, I think that sometimes, again, like as a spreadsheet guy, it's like, well, I want to put this person in place and pay them this money and then immediately see the result. But sometimes it's just like you talked about, that great person that you're quote unquote overpaying, they're doing the sales. They're getting that extra lease a week that your other guy wasn't getting. You're also getting more tours done. You're getting the better people to come in and be tenants. And then you're having less back end problems, right? You're not having as many evictions. You're not having as many R&M requests because these tenants are just a higher caliber and they're more qualified and they want to live there. And that all filters through the site staff. We're not the ones evaluating the tenants, right? That process needs to happen through the staff. And the only thing we can do is have a good picker, right? We can pick the right people, but we can't be at all our property soundings. So we need to figure out how do we bring the right people in. And I think we've got a pretty darn good system at this point. And it's just that there's a little bit of a lag.
Yeah, totally.
Yeah. So taking a step back from the operations, I think it's been a little bit of a wild ride these last few years. We had COVID and then we had the Fed pivot, and now we're having somewhat of and now we've got a new president who's going to come in and who knows what that's going to do. But I mean, anywhere you want to go in there and talk about how that market has affected, I think, two places. We talked a lot about operations. I don't know if you want to talk about capital raising and just the capital environment and how that's changed over time from when we first started raising capital to where we are today, and just your experience talking with folks and what you're hearing, I guess, from investors today.
A lot of people are facing capital calls. A lot of people deploy it into real estate and watch the S&P do like 150% while real estate's been like really struggling, unaffected by interest rates. I think there's general like pretty negative sentiment. What's interesting, and me and you have talked about it all the time, right? Like, is that the best time to be doing deals is the time when everyone's most sour on doing deals. And that's what we're seeing, right? The past two deals that we've done, like that have been the hardest to raise capital for, have been our best performing deals, right? Like it's an amazing time to buy real estate right now. You can get in at a really fair basis over the long term, right? If your deal works today in this debt environment, it's going to work marvelously in the future, right? And there's a lot of distress in the marketplace, right? Like not as much as I think we thought there was going to be, or at least the distress isn't the type of distress that we really want to deal with. Anyways, long story short, it's a way better time to be deploying capital into real estate right now than it was, 3 years ago, but no one wants to do it. So it's kind of the age-old thing of whatever Buffett said, something about when there's blood in the streets or whatever. And that's easier said than done. Investor psychology is like totally opposite of that. Investor psychology is buy when everyone else is buying, when there's a frenzy, right?
Yes. Be fearful when others are greedy, be greedy when others are fearful type of argument.
Yeah, there we go.
Well, that's sitting here and listening, so you have to do the work of talk. So I think that's right. And it is a frustrating dynamic. And I think it's not specific to where we are or our size. It's something that I think we hear and we see across the entire capital spectrum, from the institutional side, family offices, retail. Certainly people individually have different levels of conviction around that theory of like, hey, now is the best time to buy because no one else wants to buy, or vice versa. But a lot of money just moves together. And so everyone else is waiting for everyone else to make a decision about what they're going to do and how they're going to do it. And we're just sitting here sort of just as a participant trying to make our case for individual deals. But at the end of the day, right now, I can buy property for the same price per square foot that I could buy it in 2017 or 18. And so I wish I could have bought another 10,000 units in 2017 because I'd be feeling really good about where I am today, right? So if that's the case, if that's true, then if I can buy at those same valuations and rents are 40% higher and the same migration trend, population trend, all that stuff is still there, then it should be a good time to buy. I think some of the challenges that we face, and I think markets face, is that rates are really high. And so in the spreadsheets, you're not blowing it out of the water. You're not showing 25% IRRs. You're still showing mid-teen IRRs, the same IRRs that we were showing when the market was really hot. And so for an investor, a retail investor, they're like, well, how do I make sense of that? Because if I feel like it's more risky, I should get more return. And so we're contending with that sort of a mentality, that sort of anchoring bias. And then I think also people are just expecting higher cash yields. You're competing with the risk-free. And so getting distributions out, keep doing better than the risk-free rate right out of the gate in year one, which is something that in the 2021 period, I mean, you could show a 1 to 3% year one cash on cash, and that would be fine.
Show it at 0%. You could lose cash.
Yeah, you were getting the 0.25 from short term. You were getting 0 from Chase, right? Chase wasn't giving you a penny. Maybe it was like 0.01% in interest, right? And so if you could deliver 6 or 7% by year 3 or year 4, you were doing pretty good. Now, like that's almost the bar for year 1. And so, and rate growth is obviously slowed down. So I guess maybe speak a little bit about some of the things that, again, tie back to operations would be, I think, taxes and insurance. So I think that's another factor that's really affects how deals play out. And then we'll talk a little about financing costs, but insurance and taxes, how has that developed over the last few years? And how do you guys manage that on the ground to help keep those costs low since we're not in an environment where rates are moving, rates are moving as high?
Yeah. It was interesting. I was talking to an analyst at a hedge fund the other day who specializes in REITs. And she had a totally different perspective on it because she's like, your insurance is like a 4% line item and your exposure to Florida is only 20% of your total portfolio. And the maximum is going to go up is 10%. So what's 4% of 10% of 20%? But we don't look at it at a portfolio level, right? It's all deal by deal. So, I mean, there was a year where insurance in middle Georgia, nowhere near the coast. Anyway, so 120%, like that could be huge on a deal. I mean, you could go from, that's $80,000, $100,000 of cash flow that you expected to be able to be sending out to your investors. And say on that deal, you had $5 million of equity. So, that kills that 2% of cash flow away from your investors that you expect to be able to send out. It really stressed a lot of deals. I know a guy owned a deal in Florida for like 5-6 years. So got a benefit of a massive amount of rent growth and insurance blew him up. They bought it $400, $500 a door or something like that. And, was it like $3,000 a door? And it blew it. And I don't know if it blew up the deal or he had to sell it. I don't know how he did on the equity, but he had to sell it. We looked at deals. We looked at a deal on Space Coast and insurance blew us up.
I wish we had been able to buy that deal. Yeah.
I know. It was an amazing deal. It was a great deal. We probably would have been okay. But I mean, insurance moved 40% from when we went under contract from where we thought it was going to be or something, or even more, right?
The existing sponsor was paying like $1,200, $1,300, $1,400 a unit. We thought we'd get something between $2,000 and $2,400, and then it ended up going above $3,000.
Yeah, it was like $3,100 and $3,200. Yeah.
And it was a bad time when the market was year end. It was a lot of hurricanes, but I don't know if that's going to change. I think it's tough to forecast in the future. And it's tough to be in middle Georgia or middle Tennessee or middle Dallas and still getting affected. Now, maybe Dallas, there are other natural disasters, but I think you're dealing with sort of socialize the insurance risk. So like everyone takes the brunt of it, even if you are in a market that really isn't going to be affected direct, which is tough as an owner. What about on property taxes? I think it seems to be somewhat market specific, but are you seeing anything that could be done on the property tax side? Bigger line, not 4% of your expenses. That ends up being a pretty large part of when we call uncontrollables, but I'm asking you, how do we control?
It's very market specific. We have deals where it basically didn't move from when we bought it, even though our appraised value is like a quarter of what we even bought it for. So, it's very clear what the market value was, or at least at some point. And we have deals where it was fine for a couple of years. This is very common. What we're starting to see in like the secondary markets stayed very flat for a couple of years. And then all of a sudden they brought in some consultant from New York and they were like, oh, you're leaving all this money on the table. Why haven't you guys gone through and reappraised this to like current market values, blah, blah. I used to be an old boys club, South and small town, and no one really haggled too much on taxes. So, I mean, there's things that you're doing there. We're buying several deals for less than their basis right now. So that's an easy appeal. And then many markets where we do have good tax rates and we've gotten a good tax appraisal, we'll still go in for the appeal because many states will freeze it after the appeal. So I don't know. I mean, there's not a lot you can do, but we fight like crazy and do our best. If you're in Texas, you make sure that your sales price isn't disclosed. But luckily, what I really like about our markets is we don't have that danger of that reappraisal, that Texas reappraisal. Those Texas numbers can move massively, where most of our markets, it's like a free, steady, like it's after you buy it, maybe you get set to 85% of the value that you bought it for. And then it's going to be a pretty steady climb, except for those instances where they never reset it. And then they bring in a consultant later on.
But then, yeah, you're playing with the house's money at that point.
Yeah, you're playing with the house's money.
Yeah. So you came from a technology background. I always felt like real estate was a little bit behind on the times relative to other industries in a lot of ways. And you talked about them. And so, but let's talk about technology. Now we have control of our sites, or just generally what you're seeing out there. What technology is kind of on the forefront today in the real estate space, really either operationally or on the private equity side that you've seen that's moving the needle? Not just, technology for technology's sake, but what's driving higher revenue or lower expenses or control or all that kind of stuff?
Yeah, I mean, I think the biggest thing has been probably AI in leasing and delinquency. And I mean, taking a lot of the administrative and minor tasks, but that add up and are very time consuming off of folks. I mean, you really want your site team giving tours, selling units, checking to make sure that units are properly turned and are ready to be given back to leasing and fixing stuff. You don't want them following up on tour schedule dates. You don't want them following up on certain instances of late rent. Like, do they really need to send the text message or can a system do it? So a lot of things around those. Off hours leasing is huge, right? Like the first to book a tour it increases your odds by double fold. So a lot of AI and like tenant communication has been huge. I think you are obviously a massive user of ChatGPT. I created a Python script with ChatGPT. I don't write Python. I had like some background, but like nothing in Python. But Python's like the best language to be able to manipulate Excel. And so Yardi sucks massively for anybody that's ever used it.
You're going to put that in a quote and it will tag Yardi.
Yeah. But their technology is insanely old, but it's like IBM mainframes. No one can seem to get away from it. So it produced these really messy Excels and I couldn't action the data. So I created a Python script with no knowledge of Python. And I just basically plugged it in, said what I wanted it to do, would run it. I'd put back the errors and I just like created this feedback loop between me and ChatGPT until eventually I had the working script. I've just been amazed at what you can do with that kind of stuff. Power BI, stuff like that on our data visualization and being able to have really actionable data has been amazing. I mean, sometimes in the real estate space, you hear about these, what do they call them? The old Scrooges, guy in the penny loafers, everything's done on the back of a napkin math kind of thing. And not to say that those guys haven't made a killing, but it's a really old industry. So even stuff like Slack could be something that's huge. We do a lot of our recruiting in a fairly automated way with a lot of technology and tools that I think a lot of people don't do. Our payroll is an ATP or ADP or whatever it is. We use a modern solution that is like all in one and handles all of our compliance. Yeah, I don't know.
It's a lot of digitization. Yeah. I think everything's moved to, there's some software or system that is controlling or augmenting or helping us execute pretty much everything in operations. I think if we look at the acquisitions pipeline and we think about that, which is more where I sit, the availability of data is just huge versus 10 years ago. Like we still do this part, make manual calls to individual sites and confirm rents and things like that. And I know we do that on the op side too. But being able to pull that same data from 5, 10 different sources and be able to check them versus each other, and just the amount of information you can organize and validate and through third parties, I think it's just phenomenal. And I was speaking with a sponsor earlier today, and they're like, well, I'm not sure how much you can peg the rents. There's some execution risk there. And I'm like, well, I mean, with all the data available today, I'm more concerned about the things I can control, like the movement of interest rates and inflation and the GDP growth and population migration, the things that I can't be controlled, versus I can pull reports every day for every single property within, in the entire United States at any time. That's information that I feel very, very confident in. It's the unknown unknowns or the unknown knowns that are kind of bite you. So yeah, a lot of technology. Our cutoff time here with this for now, but I'm sure we'll talk 3 times more today, but I'd love to bring you back on the pod and we can chat more about vintage and diversification market and some geography stuff that we can get into. So with that though, thank you so much for your time and for sharing great insights and knowledge with us. If our listeners want to reach out and find out more about you or Carbon, what is the best way to get in touch?
I'm on Twitter, Cody Littlewood. And I only tweet about real estate. So no politics, no sports, no anything else. Real estate and carbon. And you can write me at Cody@carbon.com.
Great. Awesome. Well, thank you. And thank you for tuning into this episode of Deal Flow. Don't forget to give this podcast a follow on Apple Music and Spotify, and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else will get something out of this show, please go ahead and send it to them. Feel free to comment below in regards to future guests you'd like to see, or get in touch should you think your knowledge and expertise would make for a great episode. Thanks again from me, and I'll see you next time on Deal Flow. Thank you for listening to Deal Flow with me, Michael Pulio. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.